at the University of Wisconsin in Madison. Before beginning our discussion, I do have a few housekeeping items. Our conference call today will last approximately 1 hour. During this time, you may submit questions via the Q&A tab, which is located on your menu bar at the top of your screen. We'll certainly try to answer questions at the end of the program, but if we run out of time, we'll follow up with you individually after the conference. We encourage you to maximize today's PowerPoint to full screen by hitting F5 on your keyboard or from the toolbar menu selecting View and clicking Full Screen. If you'd like to print or save a copy of today's PowerPoint presentation, you can do so by selecting the printer icon at the bottom right-hand corner of the screen. Foley and Lardner will apply for CLE credit for you after the conference. If you did not yet supply your CLE information when you registered, please do email that to Jennifer Bartz at jbartz@foley.com. Note that you must log on to both the audio and video portions of the program to obtain CLE credit. Also, it can take up to 6 to 8 weeks for us to obtain all CLE approvals, and so we appreciate your patience. And now, finally, I will turn the microphone over to Terry Nelson of Foley and Lardner to begin our program. Terry.
Hello, everyone, and thank you. The Jumpstart Our Business Startups Act, or the JOBS Act, was signed into law on April 5th. The legislation was a bipartisan effort by Congress intended mainly to ease capital formation for startups and emerging companies. The theory behind the legislation is that less regulatory red tape will assist in the capital formation efforts, resulting in the creation of jobs across the country. It was interesting to read the headlines within the financial press immediately after the President signed the legislation into law. The act was characterized in the headlines as either a game changer, a giant step for entrepreneurship, the capital markets have finally entered the 21st century, but in contrast, some headlines read like a recipe for fraud and the return fraud to Wall Street in one easy step act. So there is a wide disparity of opinion on whether this legislation is good or not. Many of the measures included in the Act will not be available until the SEC adopts regulations. So it is certainly too early to tell whether the JOBS Act will achieve its #1 goal of promoting jobs. However, although the Act has its critics, it appears clear that the Act does provide much-needed regulatory relief for capital raising. Today, we intend to summarize the purpose of the Act, the enactment dates for the various provisions included within it, and a description of those material provisions, then discuss primarily through our two outside experts, Kevin Bogle and Professor John Eckhart, who stands to benefit the most from the various provisions, and the potential pitfalls that may result from those provisions. Let's first talk about some of the key dates for enactment of the various provisions. Title I, which is Reopening American Capital Markets to Emerging Growth Companies, which describes for the first time this new class of companies, was effective upon enactment of the Act on April 5th. Title II of the Act is entitled Access to Capital for Job Creators. The SEC has 90 days following April 5th or to around July 5th to provide regulations to revise Rule 506. Under Title III, this is the new crowdfunding exemption. The SEC has 270 days, 9 months, or to on or around January 5th to implement the provisions of the exemption by regulation. Title IV is the small company capital formation section. This speaks to the Reg A revisions, and unfortunately, the SEC was not given a date in which to complete regulations for that exemption. Title V, the private company flexibility and growth section, was effective upon enactment of the Act. This provision speaks to the increase in the number of shareholders allowed before an entity becomes required to be registered under the Exchange Act. And final Title VI, which is capital expansion, this deals with the number of shareholders for banks and bank holding companies before they reach that public reporting company requirement. Now, of course, there are no assurances that the SEC will complete its rulemaking within the time period required by Congress. In fact, the SEC has already publicly stated that it is unlikely that the rulemaking will be completed on time, at least for some of these provisions. Let's discuss the purpose of the Jobs Act. Generally, the Act is meant to encourage IPO growth, to facilitate private capital raising, to allow companies with large shareholder bases to conduct additional capital raises without requiring registration. Now, it encourages IPO growth by easing restrictions under the Securities Act relating to the IPO process for so-called emerging growth companies and providing these emerging growth companies with relief from certain disclosure requirements. It facilitates private capital raising by creating a new crowdfunding exemption, removing the general solicitation and general advertising restrictions for both Rule 144A and Rule 506 offerings, and expands the Regulation A offering exemption. The Act also allows companies with large shareholder bases to conduct additional capital raises without requiring registration by raising the shareholder threshold requiring registration, and I think very importantly, excluding from such shareholder count those shareholders who receive their securities pursuant to an employee incentive plan or crowdfunding exemption offering. Now let's get into Title I. For this conference, Chris and I will be describing the various provisions under the Act, and then we're going to follow with a discussion with Kevin and John as to the persons who primarily benefit from the provisions, how, and the pitfalls that they see in complying with these provisions. Title I talks about reopening American capital markets to emerging growth companies. There's a new class of reporting company called the Emerging Growth Company, or EGC. It's defined as an issuer that had total annual gross revenues of less than $1 billion in its most recently completed fiscal year. So this is a large pool of companies throughout the country. And the company continues to be an EGC until the earliest of the following: the last day of the first fiscal year in which it had total annual gross estimates of $1 billion or more, the date on which, yes, the EGC is deemed to be a large accelerated filer, and that's primarily having a public float of $700 million, or the date in which the EGC has issued $1 billion or more of non-convertible debt during the prior 3 years, or the last day of the fiscal year following the 5th anniversary of the EGC's IPO. So theoretically, this classification could last as long as up to 5 years after the EGC's IPO. Now, specifically, the advantages to being an EGC are as follows. In filing for an IPO, EGCs may confidentially submit a draft IPO registration statement to the SEC for non-public review. Now, an issuer that was in registration before the enactment of the Jobs Act that qualifies now as an EGC may switch the confidential submission process for future amendments as filed with the SEC. The initial confidential submission and all following amendments must be filed publicly at least 21 days before the roadshow. Only 2 years of audited financial statements are required versus typical 3. In any other registration statement or periodic report as filed with the SEC, EGCs do not need to include financial information and selected financial data or in MD&A disclosure for the periods before those presented for the IPO. EGCs may elect to rely on certain scaled disclosures available to smaller reporting companies, such as for executive compensation. EGCs and their agents may test the waters solely with qualified institutional buyers and institutional accredited investors to gauge interest before or after filing. Now, in connection with governance and disclosure, EGCs are exempt from the requirement to conduct say-on-pay and golden parachute stockholder advisory votes. It's exempt from disclosing the pay for performance in CEO pay ratio. It's exempt from the auditor attestation of internal controls under Section 404 of Sarbanes-Oxley. Now, after a certain time, there is a phase-in of governance and disclosure requirements for an EGC. For example, the say-and-pay requirements phase-ins are as follows. In case of an issuer that was an EGC for less than 2 years, it's by the end of the 3-year period following its IPO, and for any other EGC within 1 year of having lost its EGC status. EGCs are not required to comply with any new or revised accounting standard until the date the standard becomes broadly applicable to private companies. EGCs are not subject to any public company accounting oversight board rules requiring audit firm rotation or modified audit report requirements unless the SEC determines later that that is necessary for such filers. The EGC may opt out of any EGC status exemption and instead comply with the requirements that apply to other issuers. However, if it elects to forego the exemption from compliance with new or revised accounting standards, it must comply with all standards and cannot selectively opt in or out of accounting standards. And they also must make this election at the time it files the first registration statement or Exchange Act report with the SEC. Research reports on EGCs that propose to register or are in registration are not offers under the Securities Act, even if the broker-dealer participates in the offering. Research reports on EGCs are not subject to quiet period or lockup period restrictions. Now, with these regulatory easements within the IPO process, EGCs should realize the following benefits: a significant reduction in accounting expense, underwriter due diligence, and the comfort letter time and expense, which should all result in a less expensive and faster IPO process. It allows the issuer and underwriters to test the waters by speaking with potential institutional investors prior to making a decision whether to file the registration statement with the SEC. It allows companies to keep their business strategy confidential until later in the IPO process, thereby reducing the risk to the issuer that its information will be public prior to having any assurances that the offering will be successful. And finally, the easing of the restrictions on research published by broker-dealers around the time of an EGC's IPO should help address the lack of research coverage for EGCs. Also, the removal of certain restrictions regarding communications between security analysts and potential investors should help free out the amount of research and analyst information available to invest in EGCs at least immediately post-IPO. Now Chris will discuss the other titles under the Act.
Thank you, Terry. Good afternoon, everyone. The first thing that I wanted to address was Title II, and specifically the access to capital for job creators. That title specifically and quite bluntly requires the SEC to eliminate the ban on general solicitations and general advertising for Rule 506 and Rule 144A offerings, provided that the securities sold pursuant to those offerings are sold only to accredited investors for purposes of Rule 506 or to qualified institutional buyers for purposes of Rule 144A. Now, in doing so, they draw the law draws a distinction between 506 and 144A in that under 506, the issuer must take reasonable steps to verify that the investor is in fact accredited, versus under 144A, they've embedded the concept of reasonable belief. Now, a lot of the commentary that you may or may have not seen have pointed out this distinction and have been concerned, I think justifiably, that without a reasonable belief standard also embedded under 506, they're creating an absolute standard that if it turns out, even if you had a reasonable belief under 506 that an investor was accredited, if they are in fact not, you've blown the exemption. So one of the things that people are pushing for the SEC to consider is, as part of whether I have taken reasonable steps under 506, if I can also rely on a reasonable belief that the investor was accredited. Now, opposing that is the concern that in the commentary, it seemed very clear that the Congress was intending more than a simple check the box or affidavit in terms of what will constitute reasonable steps. So we'll have to see how that shakes out. The other thing that will remain to be seen, subject to SEC comment in the promulgating regulations, is what additional restrictions, if any, they will place on the general solicitations and ads. For example, some of the commentators have queried whether or not private funds should be able to display performance ads, touting their rates of return on previous deals. There's a concern that unless there are some unifying standards of how returns are measured, that you may have an apples and oranges issue of funds trying to claim what their performance was on past private deals. Another aspect of the advertisement concern is to what extent will investors confuse the ad for something that's not a private fund, for example, a mutual fund. And so there's been some discussion as to whether or not additional legitiming or disclaimers should be placed on the advertisements to make it clear that it is a private fund targeting only accredited investors and is not akin to a mutual fund or something of the like. And then lastly, I'll point out that as part of it, some of the commentators and some of the articles have said if we're going to open up, eliminate the ban on general solicitations and general advertising, provided you're selling to accredited investors, do we need to revisit once again, for purposes of that exemption, who's considered an accredited investor, particularly when you're talking a natural person. And there is some talk about should the SEC revive earlier discussions of raising the net worth to something more along the lines of $2.5 million to be qualified as an individual accredited investor. Okay, next slide, please, Terry. So I want to jump now into Title II, and as we'll see, there's some overlap between the advertising concept in Title II and here as well. But Title III is about crowdfunding. And crowdfunding, this is probably, to Terry's point, this has garnered a lot of attention because it has sort of I think the widest applicability when they talk about opening up investment opportunities to those outside the so-called 1%, wealthy accredited venture capitalists, super angel funds, and the like. So it has a huge potential to democratize investment, but as the chairman of the SEC has said and some other ones, some people also fear it's a ticket to fraud, and that we're going to see lots of small investors being bilked out of their money. So, but let's jump into how they define it. So it's a new registration exemption for offerings, so long as the aggregate sale by an issuer, measured over a 12-month period, doesn't exceed $1 million. And then as a further cap on an investor level basis, it looks at the net worth or the net income of the applicable investor. And if the net worth or net income is below $100,000, that investor is limited to the greater of $2,000 or 5% of their annual income or net worth. And if your net worth is equal to or more than $100,000, then what you can invest as an individual can exceed $100,000, but it's capped by 10% of your income. Now, there's lots of issues embedded in just that brief description, or lots of things to consider. For example, what is a permitted offering or security under such offering? The act is silent. Therefore, the assumption is that there's no restriction on the type of security that can be offered, whether it's just straight common stock, preferred with different classes and rights, convertible debt, for example. So the assumption is the SEC won't place restrictions on the type of equity that can be issued pursuant to it. The other thing that's important to point out is this is an offering that is considered to be exempt. They're covered securities, so they're considered to be exempt from state registration requirements, which essentially means no fees. The state can still require notice filings and the like, but they can't charge registration fees. Another issue is for purposes of measuring whether or not an issuer has raised more than $1 million, the Act isn't clear that by that it means $1 million raised pursuant to crowdfunding raises as opposed to private placements, for example. And again, a lot of the commentary and articles have said the SEC needs to make it clear that for purposes of the aggregation doctrine that you should not include private placement offerings or offerings that are exempt under different exemptions versus the crowdfunding exemption. The other thing that I think, and a lot of commentators think they need to clarify, is it talks simply about any investor in a crowdfunding offering, and it does not draw a distinction between investors. So, for example, as we all know, the SEC often talks about retail investors, institutional investors, and accredited investors. And simply by stating investor, they're leaving it open if they mean all three, or if they really meant only a retail investor. Again, it's my belief, and the belief of a lot of the commentators, that the SEC should probably make that clear that they're simply talking about retail investors and not accredited and institutional investors for purposes of the net worth limitation. Another thing related to the crowdfunding as it relates to the investor themselves is the Act places a 1-year transfer hold on the securities purchased in a crowdfunding exemption, or a crowdfunding offering, excuse me. The only exceptions to that 1-year rule are in the case of, there's general exceptions like back to the company, to friends and family, or as part of death and divorce. And that's not very problematic. What's more problematic is the held of record issue, which, as we'll talk about in just a bit, one of the other titles increases the count from 500 to 2,000, essentially, in terms of shareholders that you can have before you have to register. Securities issued pursuant to a crowdfunding offering are not counted. Those shareholders are not counted towards that count to see whether you have to register. But the way that the Act is drafted, it appears to follow the holder of the security, not the security itself. And so the concern is, of course, you may have a number of shareholders in a crowdfunding exemption that could exceed the limit under which you might otherwise have to register. And so the concern is after a year, if a bunch of people transfer and those transferees are no longer subject to the exemption, in other words, they're counted for purposes of the held of record count, you could end up with companies, in theory, having to register 1 year after their crowdfunding offering, because once these transfers occur, those transferees will be counted for held of record, and they'll blow through the limit, and they may have to register as a public company. So the concern, of course, is that the SEC clarified that the held of record exemption should apply to the security that is purchased in that crowdfunding exemption, and every transferee subsequent to that will benefit from that and not be included in the shareholder count. But that remains to be seen. Okay, next slide, please, Terry. Let's look briefly at the required issuer disclosures. So if you're an issuer intending to take advantage of a crowdfunding offering, you have to provide a fair bit of detail, not surprisingly. Obviously the name, the legal status of the entity, where you're located physically and where you're located on the internet, names of directors, officers, 20% shareholders. And then, perhaps most importantly, the description of the business, the anticipated business plan, which will include the purpose of the offering, the use of the proceeds, and the pre-raise ownership and capital structure. The next thing a issuer has to do as well is there's a scalable financial disclosure. And the way the Act approaches this is it creates brackets around the amount you're trying to raise. If you're trying to raise less than $100,000, you're required to provide tax returns and a CEO certified financial statements. If you are trying to raise north of $100,000 but less than $500,000 in a single offering, you have to provide financial statements that have been reviewed by a public accounting firm. And then lastly, if you're raising north of $500,000, you need to provide fully audited financial statements to putative investors. And then last, not less than on an annual basis, you have to file a report of the results and operations and financial statements, as will be further set forth in SEC regulations. Now, an important, it's not a disclosure, but it's a restriction on the issuer, and that is namely for purposes of advertising. The issuer cannot advertise the offering other than to direct investors to the broker-dealer or the portal, and we'll be talking about that mechanism in just a minute, other than to direct them to that site. And so the concern around that, of course, is that that's unduly limiting, and that any issuer, particularly if we're talking smaller companies by definition, taking advantage of crowdfunding, may want to use social media, brief correspondence, have a blurb on their website, contact families and friends without having to legend everything they do. So, for example, if they wanted to tweet about it or wanted to post a brief email. So a lot of the commentary talk about the SEC making it clear what is and isn't an advertisement or what would be permitted to allow the issuer some freedom to take some advantage of technology and social media to be able to get a little bit more out about the offering other than just simply, I'm doing an offering, go to this website. So that's, I think, one of probably the bigger areas that will need to be settled by the SEC to give greater guidance to issuers about what they can and cannot do. Now let's talk about, next slide please, Terry, how the crowdfunding is conducted. What the Act provides is that a crowdfunding must be conducted either through a registered broker-dealer or a funding portal. And in both cases, obviously, it has to be registered with the SEC and an applicable self-regulatory organization, and provides investors interested in the offering with such disclosures as the SEC determines is appropriate. Now, to the extent you're not a broker-dealer and you're going under the portal exemption, the SEC has made it clear that, or excuse me, the Act makes it clear they don't want success fees, and they ban success fees, and they ban, compensation for promotions of the offering. Now, that leads or begs the question, will the SEC make it clear that broker-dealers and funding portals can charge other fees, initial fees, management fees, closing fees, administrative fees that aren't considered success fees, and therefore provide a way or another way for a portal to monetize the offering such that there's a viable channel of portals and broker-dealers willing to undertake what obviously cannot exceed any more than $1 million for a single offering. Now, there's a whole host of other restrictions. Next slide, please, Terry. For brokers and funding portals, they cannot compensate a promoter for providing the broker or funding portal with personally identifiable information. Obviously, an indirect attempt to minimize that sort of incentive and minimize what could be the unlawful gaining of or unauthorized provision of personally identifiable information. The portal also cannot allow their directors or officers or partners to have any financial interest in an issuer. Now, this raises an interesting question. Some of the commentary said you need to make it clear that by financial interest, you should include equity as well. So clarifying that financial interest would include equity. The other thing that's not clear is the time at which that financial interest or lack thereof is measured. The assumption is that it's at the time of the initial offering, and that subsequent to the initial offering, the broker or funding portal could in fact have a financial interest, but that's not clear. So again, the SEC hopefully will clarify if there's a moment in time in which that's measured, or it's an absolute prohibition on any sort of financial interest regardless of the time. The next is that the portal or the intermediary needs to take certain measures to reduce the risk of fraud, including background checks and securities enforcement regulatory checks. Now, an open issue here, a very open issue here, is to what extent can the intermediary rely on the issuer conducting background checks, et cetera, and so forth, and providing that information to the intermediary to make available to investors versus having to independently verify the veracity or the accuracy of that information being provided or collect it itself in the first instance. So that's a big gap that needs to be clarified. The intermediary also has to provide to the SEC and potential investors all of these issue-required securities no later than 21 days prior to the first day the securities are sold to the investor, which makes sense, of course. You want to give ample time prior to the closing for the investor to consider the information relevant to the investment. Lastly, the intermediary has to ensure that all the offering proceeds are only provided to the issuer when essentially the aggregate capital from all investors is equal to or greater than the offering amount, which makes sense. But along that line, they also have to provide a right of rescission to the investors. Again, they've left that open to what that rescission right is, namely, when it has to be exercised, under what circumstances, under what notice. Again, a lot of the commentary, and I tend to agree with it, is they hope that the SEC provides concrete rules in terms of definitive time, 48 hours, 72 hours, some minimum period of time in advance of the closing to exercise the rescission right. So there's some certainty at a point that the intermediary and the issuer knows that they have sufficient funds to close. The other thing that the intermediary has to point out, and again, there's really no guidance on this yet, we'll see what the SEC says, but ensuring that investors are able to review required investor education materials and an understanding of the risk of the offering. So presumably something beyond the specifics of the issuer and the offering itself, but the general risks in investing in these types of securities, investing in a crowd-funded sort of investment. And that includes instituting investor privacy protections and then also not selling investor information. So lots of requirements, lots of restrictions on an intermediary, and we'll just have to see how the SEC balances that out because everyone understands that a lot of these protections were added in the last second over the SEC chairwoman's concern and other concerns that this would otherwise be a blank ticket to fraud. And while that's understandable, there has to be a viable mechanism in place where intermediaries can provide this valuable service at an economic reward that makes sense to them and is not so overly burdensome that no one wants to take advantage of it. Okay, next slide, please, Terry. Title IV, the small company capital formation. This is the changes in Regulation A that Terry alluded to earlier. Increasing, essentially, very simply, increases the maximum offering amount under Reg A substantially, from $5 million to now $50 million during any 12-month consecutive period. Now, securities offered in a Reg A offering are covered securities and therefore exempt from blue sky, provided that they are offered or sold on a national security exchange, or offered or sold only to qualified purchasers, which the SEC will have to define in its regulations. Next slide, please, Terry. Some of the features. The securities issued in the new Reg A are not restricted from resale. The issuer, not surprisingly, is required to annually file audited financial statements. And the SEC can, by rule, require the issuer to file periodic disclosures with the SEC. Okay, next slide here, Terry, please. I alluded to this one earlier. Title V, the Private Company Flexibility and Growth Act, or provision of the Act. This sort of the Facebook issue, right? This raises the held of record or the record holder registration for issuers from 500 currently to, prior to the Act, 500 or more persons to either 2,000 or more persons, or 500 or more persons who are not accredited investors. And as Terry had mentioned before, people who receive securities pursuant to employee benefit plans and exempt transactions or pursuant to an exempt crowdfunded exemption, are not counted. Now, as I mentioned several slides back, there's a sort of a huge potential hole there where it appears that the held of record exemption for crowdfunding may currently or may be interpreted to only apply to the initial holder and not the subsequent holders or subsequent transferees, and that hopefully they'll decide that runs with the security and not with the holder. And the next slide, please, Terry. And then lastly, for my purposes, similarly for banks and bank holding companies, they've raised the record holder registration trigger from 500 or more persons to 2,000 or more, and raises the deregistration shareholder trigger from 300 or fewer to 1,200 or fewer. Okay. All right, the next thing I need to briefly cover as a aside for those of you out in the audience who are seeking New York CLE credit, those attendees or listeners are required to email the following 5-digit code to Jennifer Bartz at Foley, and her email address is jbartz, J-B-A-R-T-Z, at Foley.com. And the code you need to transmit to her is MDNEH. That's M as in Mary, D as in David, N as in Nancy, E as in Edward, and H as in Henry. One more time, those seeking that credit should email that following 5-digit code to jbartz at Foley.com. Okay, now what we're going to do is we're going to transition to the potential beneficiaries and potential pitfalls. Terry?
Yeah, and I think the way we'll do this, we're bringing in Kevin and Professor Eckhart to discuss the beneficiaries of the various provisions under the Act and the potential pitfalls. And Kevin, I think we'll start with you first with respect to the benefits to EGCs and the potential pitfalls with respect to those parties. Kevin?
Okay, perfect. I think, first of all, Terry and Chris, you guys did a great job in going over the titles within the Jobs Act. This first page here talks really about the Title V and Title VI, the shareholder threshold for registration. And I think, Terry and Chris, you both pointed out some of the benefits earlier on, but one of the main things here of increasing the 500 to 2,000 shareholder limit for the shareholder threshold, it allows companies now to actually go out there and increase their financing opportunities out there in the marketplace. And without going over the 500, previously they had to disclose certain things with the SEC, and now they don't. So that would reduce the cost that they have and increase their ability to go out there and increase financing opportunities for their business. So I think that's a very big benefit out there for private companies who are out there who are looking to find financing opportunities without the increased cost of disclosing information with the SEC. The last part there on the bottom of the slide is those public reporting companies whose shareholders base is below the new shareholder standard may choose to withdraw from being a public reporting company and avoid the associated costs. So that one's important as well. So for example, if a company has exceeded previously the 500 shareholder limit, now they could actually withdraw and actually reduce the SEC reporting that they have because of these new rules. And I think that's going to be a great benefit to companies as they look to save costs and actually look for that increased financing.
Kevin, before you go further, I'm thinking about the reduced or the increased number of shareholders that are allowed, which includes the 500 accredited investor test. I'm wondering, it seems to me from a practical standpoint, the company, in order to stay under those numbers, are going to have some type of system to track investors. And determine, I think, on a periodic basis whether or not they still meet the accredited investor standard. So it's not as simple as you would think. It's going to take some creative thinking and relationships with those shareholders to maintain that number.
I think you're right, and I think there's already companies who are up against the old 500 threshold who probably have those systems and processes in place. And right now, if they could expand that to 2,000 and eliminate the need for exempt employee share option plans that they may have, it'll increase their ability to go out there and increase their financing opportunities. So I agree with you. There are going to be companies who need to put those systems and processes in place to monitor these thresholds, but there are going to be a large number of companies who already have these systems, and the increase in the threshold is going to benefit them in their ability to go out there and get that additional financing.
Okay.
And then just the first point on slide 26 is really just talking about the EGCs as well. And I think, overall in Title I, there's a lot of benefits that Terry walked through in terms of the benefits for EGCs, but, the overall thing that they're trying to do is reduce the cost and increase the speed to actual market. And that's something that EGCs have been looking for. It allows for, as we talked about, it's little things that people may not think about, but that ability to file confidentially allows companies who were previously afraid of filing because if they had to withdraw, they felt that they may have been tainted in a way that would reduce their pricing once they go effective. So with the ability to file confidentially, companies are more confident and secure about going through the IPO process. And if there's an ability to reduce their cost and speed to market, they're actually thinking that this is probably a viable solution for them. And, talking with various companies, domestic companies, a lot of them have been going to other markets outside of the U.S., whether that's Canada, Hong Kong, places in Europe as well that have less costly, I would say, in some of their minds, IPO pass, then we'll be bringing those actual companies back to the U.S. and actually having them actually list here, which is going to be something good all around for the U.S. economy and what the Job Act's trying to promote in terms of increased jobs and increased market activity here within the U.S. So that's something that I think is a benefit for the EGCs and just overall the market as well.
So, Kevin, what do you see as some of the pitfalls that EGCs may want to consider in whether or not to opt out of the various regulatory easements that have been provided? What are you hearing as to considerations about that? And also, how does it affect underwriters who may be considering helping an EGC go public as to how they see the reduced requirements and how the public might accept or not accept an EGC with lesser requirements?
I think when you talk about public perception, I think that's going to be very important. There hasn't been any companies who actually use this yet that I'm aware of. And the conversations that I've been taking apart have been, how will this affect the ultimate pricing of the shares and the evaluation of the company at the end of the day? And the biggest conversation that I've been having with companies is, you could save $1 million, $2 million by using some of these options within the Jobs Act. But if that will reduce the ultimate valuation of the company and ultimately the proceeds that you're going to receive from the IPO, what is the cost benefit? Would you take the exemptions that they're offering here and then end up with $10 million less of proceeds? If that's the case, then it's probably better for you to actually not use these exemptions if you're going to get actually more proceeds from the offering if you don't take these exemptions. And I think it's all due to public perception right now. So underwriters and companies aren't sure what it's going to do to their price. And I think that's one of the key things that companies, underwriters, auditors, accountants, they're talking about right now, because they're not sure how this is going to ultimately affect the pricing of the shares. But right now, I think overall, there's a lot of good things in the Jobs Act to reduce the burden of actually going public in the U.S. And I think that's going to draw a lot of companies who are thinking of going abroad actually to file here. And I think it's going to actually be better in the long run. But there may take some time for companies and the market and investors to get used to the exemptions that are in here and how they will really impact the companies. But I think it will take a little bit of time before it all balances out.
Yeah, with the recent Facebook controversy, in part of the issue is what was disclosed that was non-public by the lead underwriter to, preferential institutional investors. And here, under the Act, we have an easing of the regulatory requirements, certainly with respect to what can be said and can't be said during the time the registration statement's not effective but has been filed. So you're absolutely right, Kevin. It's what the public feels about these things. With Facebook, that's not a good sign for IPOs, and it may make underwriters even more restrictive and more cautious on the companies that they want to take public. And so the public mood, they can continue to ease requirements here, regulatory requirements, but if the public isn't in a mood to buy, it just doesn't matter. John, getting to your part in connection with the various exemptions, both the new and the revised, I guess I'd like to get your take on what you see as who's going to benefit the most from these various changes.
Good afternoon, everyone. This is John Eckhart, professor at the University of Wisconsin. And I will start with the second and third points on this slide. The second point really just highlights sort of strategically an aspect of the changes in the Jobs Act as far as financing that basically makes it a lot easier for firms to try and find and locate and accredited investors, right? So they're now permitted to engage in public advertising and general solicitation as long as they're ultimately raising funds only from accredited investors. The second point also essentially creates a whole new pool of investors for early stage companies through the crowdfunding exemption. And so this basically permits these firms to raise funds beyond accredited investors and beyond friends and family now to people who are not accredited, who are essentially more distant or through essentially an arm's length transaction. And for the most part, I'm going to focus most of my comments here on the crowdfunding exemption and potentially how this crowdfunding exemption might pan out practically for entrepreneurs and people who are trying to help entrepreneurs finance their firms. So my first real point here is that any kind of lifting of restrictions on the ability for entrepreneurial companies to raise capital is particularly a good thing, and this bill certainly is a step in the right direction. But it does pose some practical challenges. So, for example, for growth companies, it's often best to select early-stage investors very carefully and to view them as much as business partners as well as providers of capital. In terms of financing, this is particularly the case because in many cases, early investors are required to accept unfavorable revisions to previously negotiated contractual terms in their investments for both their investment and the firm to be successful going forward. So, for example, you might have a seed investment round that was granted some favorable terms, perhaps some warrants, that might be unacceptable to a later round of investors such as venture capitalists who might be providing a very significant investment into the firm. Sophisticated investors certainly understand that this is sort of part of the process here and know that they might have to give up something that they previously had to make sure that the firm is successful and their investment is successful. However, if a venture took a crowdfunding round early on in this process, which, $1 million kind of, sort of looks like a sort of Series A round type of investment, they're suddenly going to find themselves potentially with 2,000 shareholders who many of them will not be accustomed to this sort of revision in the contractual terms of their investment. And this might create a lot of challenges for them going forward. And so one implication here is that the crowdfunding exemption might be most suitable for companies that are expecting that the crowdfunding round, let's say the $1 million, might be their last round or all that they need. Okay? If you think about instead using the crowdfunding exemption for a later round, and you might say, look, what I'll do is I'll use it, right before I go public or maybe a year or so before that. The challenge there is that there's a cap on the size of the round. It's $1 million, and at that juncture, if a firm is raising capital, they often need something that's larger than that. And so the crowdfunding exemption might very well be most effective, be most suitable for those types of firms that are not sort of like a biotech firm or a firm with a very long runway or a firm that will be expecting to repeatedly turn to outside investors to finance its needs, and instead be quite suitable for a company that doesn't need an immense amount of capital to get itself profitable. There is kind of sort of like a potential permutation here to sort of think about here is that if the terms of the crowdfunding security can be structured such that the firm could buy back those investors, they have some sort of buyback right, that might make it more attractive and might make it easier for them in some way to sort of handle some of the issues I just raised before about multiple rounds. Another comment here is that these crowd-funded firms will most likely need your advice in terms of finding more sophisticated directors than maybe they're typically used to having at earlier stages. So for those of you that work with entrepreneurs as they're first getting off the ground and then you take them all the way through the IPO process, essentially often these early directors are themselves angel investors who are very accustomed to managing people that are like themselves. And in the case of a crowd-funded deal, essentially what you're talking about is needing somebody who has both the skills and the sophistication to be able to handle a diverse group of shareholders, be very tactful in their communication, and they may very well need your help with that. If we could jump to the next slide here.
Yes, you did.
Oh, okay, it's already on there.
That's right.
And so on this next slide, I guess that just a couple of highlights here is that, as has been coming out in the previous discussion, is that there is certainly a fair number of legal and regulatory hurdles for the crowdfunding offerings, and many of the details have yet to be spelled out. And I think what is unknown right now is certainly probably more significant than what is known. The second issue here about individual liability is certainly out there, and I guess as these deals are being done, we'll learn more about the liability that the officers and directors are going to be facing in a practical matter. And lastly, there is the potential for a pretty significant punishment which is highlighted here in the third point on the slide, and that's basically saying that if there is a crowd-funded issue that occurs, and then if there's a non-accredited investor in a round that previously was advertised as only having accredited investors within it, the punishment here is that a firm may lose its registration exemptions that have been talked about in our discussion. So maybe I'll stop there for a moment and see if there are any questions, Terry.
Sure. Yeah, John. So this is Chris Gaines. Another thing that I wanted to ask, we just have a couple minutes here, and then Terry will have a summary. But one thing that I was very interested in, just recently, it might have been as recent as yesterday, there was a study released that indicated that very few small business owners appear to be interested in taking advantage of crowdfunding. Now, so they were drawing a distinction between, I believe, a startup and a pre-existing small business, which could be non-tech, high-tech, whatever. But I was just intrigued that already very few of them that were surveyed expressed an interest in taking advantage of crowdfunding. What are your thoughts on why that might be?
Well, I'm not directly familiar with that study, but if it is sort of a survey of the population of general small businesses, most small businesses in the United States don't have sort of the capital requirements that we're talking about here, and if they are, and they have a variety of financing options that are sort of outside of what we're talking about here, such as securitized lending to finance equipment, machinery, and real estate, and so on, and they'll probably have previous financial arrangements with banks and other funding sources. And the limit on the amount of crowdfunding that a firm can engage in is, the $1 million cap, I think, is significant because it comes with the potential of having a large number of shareholders and a lot of regulatory and sort of strategic uncertainty. I think that, maybe 5 to 10 years from now, once we know more about how crowdfunding works in practice, that small business owners might change and they might actually use it for a tool in particular firms that are, not small, but maybe sort of more modest in size, may find this as a valuable tool that before they hadn't really considered.
John, my observations is that they made this exemption way too complicated, and that might be dissuading a lot of small businesses from even attempting to do this. And, of course, we're going to have to wait until the SEC promulgates rules, but it's awfully complicated, and if anything, this promotes jobs for attorneys, it seems to me, more than anything else. But I would like to thank you all. In wrapping up today, let me just say this. The Jobs Act provisions hold considerable promise to ease regulatory requirements to make it easier to raise capital. Hopefully the SEC will be able to complete its rulemaking mandate so that all of the regulatory relief can be reasonably available within the time frame specified by Congress. Time will tell, of course, whether the Jobs Act will promote jobs creation, but even the most hardened cynics would have to agree that the provisions are significant enough to increase the ability of issuers to raise capital from the public. Thank you today to my fellow panelists for their valuable time and insight, and thanks to the members of our audience for their interest and attention.
And thank you, Terry. This is Jessie Lockman-Allen again from Foley and Lardner. I want to also offer my thanks to all our panelists today for their excellent insights regarding the Jobs Act. Because we didn't have time to get to your questions, we will follow up with you individually after the conference if you did, in fact, post a question. Also, the contact information for our panelists is on the slide deck, so if you'd like to contact one or more of our panelists individually, you should feel free to do so. The PowerPoint and recording will be available on our NDI website within 24 to 48 hours of today. We ask that you please mark your calendar for the remaining sessions in the 2012 NDI Checkpoint Web Conference Series. June 13th, July 18th, August 22nd, and December 5th. Topics and more details regarding these programs will be forthcoming. We certainly hope that you enjoyed today's presentation and ask that you please take 30 seconds to participate in our brief online survey at the conclusion of this call. These surveys are very helpful to us in ensuring that our NDI programs are providing you with practical advice and recommendations, and also for help in developing ideas for future NDI topics. So thanks again for attending our NDI program today, and we'll talk to you next on June 13th, 2012. Thank you.
Ladies and gentlemen, this does conclude today's conference. You may now disconnect. Thank you.